Now, we've spoken about this already. It's been a period of uncertainty and consolidation for the Indian equity markets, and a lot of small investors will look at the year 2025 and say it was a bit of a wasted year. I like to argue against that, because if you can call it a year of consolidation, you can also call it a year of accumulation. It is a period of time when there was a lull after a frenetic pace of growth for the Indian equity markets. But think about it. You had domestic institutional buying that was powered by mutual fund flows, which has been strong. It has only somewhat mitigated the impact of foreign institutions selling. And we've been talking about that as a theme. With this breakthrough in the negotiations that you've seen on the trade front, both EU as well as the US and the other 3 deals that have taken place over the last year, the question is, do these foreign institutions come back? What are the key threats? What are the key opportunities heading into financial year 2027 at a time when earnings in corporate India seem to have just about turned a corner? Now, of course, I've only just about given you a snapshot of what you can look for in this next panel, because you're going to see people that you normally see on NDTV Profit, but I think it's going to be more exciting, particularly because you don't normally have these conversations in New Delhi. These are conversations that we're used to having in Mumbai. So I'm pretty sure that the atmosphere here will energize these representatives of Dalal Street and our very own anchors from the newsroom in NDTV Profit to give you a sense of what you can look forward to in the rest of 2026 for India's equity markets, and whether we can claw back some of the ground that we've lost against several global markets, and whether Indians looking to invest in India can really benefit from staying the course. The panelists, let me introduce you to them. We've got N. Jayakumar, who is the Managing Director of Prime Securities. Please put your hands together for Mr. Jayakumar. If you can make your way to the stage, sir. On the right. We've got Dharmesh Mehta, the Managing Director and Chief Executive Officer of DAM Capital Advisors. Sir, please make your way to the stage. We've got Gurmeet Chadda, CIO and Managing Partner of Complete Circle. And I actually should have introduced her first, but I missed it. So let me amend that. Devina Mehra, the founder and CMD of First Global. Please, big round of applause for everybody on stage. To take this conversation forward, we've got NDTV Profit's Managing Editor, Tamanna Inamdar, as well as Executive Editor, Neeraj Shah.
Let me kickstart the conversation. Markets wait for nobody, 9:15. It starts. Tamanna, wherever she is, should be joining us any moment. But, well, this is a panel that I only can dream of, because getting all these 4 people together is nearly an impossibility. So the television audience, I'm sure, is thrilled. Alex, make amends on your behalf and start off with the lady first on the panel. Devina, it's been a while that we've spoken, but I'm glad that we're talking today. And since it's been a while that we've spoken to you, I would love to know whether 2026 brings out Devina Mehra as being optimistic, considering that 2025 Indian markets have hardly performed, or you're still a bit skeptical despite the trade deals, despite maybe the anti-I trade starting to play out and whatnot?
So even before the trade deal, or for that matter the budget, my view was that 2026 may well be, at least in probability terms, better than 2025, and the simple reason being that for the first time on television, on digital media, I saw all let us say people from my industry enumerating the risks in the market. Normally everybody is only selling the quote-unquote India growth story, and sentiment is a contra-indicator, not my opinion. That's data in every research study in every market in the world, not just India and the US, but even Portugal, Brazil, across the globe, wherever the study has been done, it's the same, that when there is fear, there's anxiety, there's uncertainty. When you hear questions like, should I stop my SIP, should I get out of the market, the next period returns are above normal in terms of probability. And it is when you have very, very buoyant sentiment, as was the case the first 8-9 months of 2024 when people thought 30% compounding was there for the taking. I mean, I actually had family officers telling me this, that I don't have unrealistic expectations. I'll be happy with 30% compounding. I said, that is an unrealistic expectation. But I had my RMs telling me that, people are saying that आपकी मैडम सुनने में तो अच्छा लगता है, but वो तो मदर टेरेसा की तरह बात करती है. आप क्यों रिस्क की बात कर रहे हैं when everybody wants small cap scheme and make some money? People said, I want to take high risk and get high returns. I said, only thing certain with high risk is high risk of losses. Nobody is guaranteeing the high returns. But at that time, nobody wants to listen to that. And that's why that whole somewhat you got zero returns. And actually 2025, the indexes don't even capture the pain in the market, because while, for instance, the BSE 500 was up, the median stock was down. 57% of the stocks were down. 40% were down more than 10%. Now the figure is even worse with a very bad January. January, India was the worst performing market in the world. Among the major 41, 42 indexes, we were right at the bottom. And the sad part was that the top 5 were all emerging markets. So this has been a boom time for emerging markets, and still we have not performed. But as I said, just because the sentiment is bad, maybe that is the good news. And that's been my view, that I never give a 1 year, never have given a 1 year index projection either in January or the beginning of the new Samvat. But certainly I would say that things don't look quite so bad. My recommendation has been A, never have 100% in equity. B, that whatever is your equity allocation, certainly not time to sit it out. You should be invested. Maybe not in the same old stocks that you have in your DP, but you should be invested.
Wow. So that's Devina, what I love about Devina is you always tell it how it is. It's unvarnished. So when Devina is saying that things are not so bad, that means you can probably expect a very positive turn. but I wonder how, Jakes, I want to come to you. The way markets have responded to the events of the last few days, I think the fact that there was a trade deal was met with euphoria. And then there was some skepticism that did we actually get a good deal or not? How do you see the joint statement and announcement today? And in the light of everything that's happened, is the STT pain now seeming very far away?
That's a, well removed from the markets kind of question, because this is something which I guess my predecessor and batchmate Anantha Nageshwaran would have, I say predecessor as in on the podium here, would have answered. I think, the fact that a trade deal has been announced, a number of 18% has been put in there, and there have been carve-outs for industries, etc. I think the uncertainty is out of the way, largely. There are still elements which need to be negotiated, as the governments on both sides will tell you. So at one level, I think a lot of money that came away from India was because they felt that India was getting the raw end of the stick for one reason or the other. And over the last 1.5 years, and I'm kind of dovetailing this with what Devina was saying, just to bring context here vis-a-vis the markets, which is that a reversion to mean is in the process of happening. And even more definite than just staying on the fence, I feel that money that went away did so, and over a period of the last 1 year, which is, by the way, just happens to be a Jan to December period. I mean, it could be any period really, and we shouldn't look at markets in a 1 year time frame necessarily. But we've been the worst performing markets. The currency of investment has weakened for most foreigners. We've been down, we've been flat, so effectively we're down between 10 and 15%. And if you happen to be an unfortunate European investor, you've been down close to 25%. Yeah. So given all that, I think there is a reversion to the mean. If you see the Asian markets and some of the tigers that have performed well, they've been coming off. So I think the first sign of flow back of money is beginning. This is a trend that doesn't stop in 1 week or a few days. And therefore, I believe that it's providential that the trade deal has been announced when it has, because it's also coming at the worst end of desperation, the worst end of people feeling sick and tired with markets, people rattling off reasons as to why SIP shouldn't be continued, etc. So from that perspective, I think we've put in market parlance, a great technical bottom, a great sentiment bottom, not necessarily on valuations, but that's where I think the markets, you need to look at stock specific. But there are one or two sectors that have come away very, very positive out of this entire thing.
Like which ones?
Well, if somebody cares to read, and I hope people do at least read 3-page press releases of two governments for starters. If you see what's emerged yesterday, one industry which I'm extremely positive about is the pharma industry. Because that genuinely, and the last sort of study that they did in the US talked about almost $1 trillion of savings that the generics pharma space has brought to the US market. So if there's something that reduces the cost to the US consumer, is non-threatening to the branded, patented guys, if you will, other than a price erosion, and works well for politicians in every country, it is the pharma industry. Of course, there's competition, but even vis-a-vis some of our other peers, where pharma specifically has been taxed or tariffed, if you will, I think we've come away pretty strong. And the reason I quickly switch to a sector is sometimes we can waffle in generalities, and with the ticker going down, I just thought that maybe we should focus on a few specifics as we go along.
We love it.
Yeah. No, this is beauty. Actually, sorry, but is there the second sector you want to mention it?
No. I think we should
fine.
we'll talk about it as we go.
Yeah, the first two answers made me feel, made me think of the Shahid Kapoor speech in Jab We Met, where he says, "Saddi to band baj gayi hai, jitna bura ho sakta hai, ho gaya hai, abhi yahan se sirf acha hi ho sakta hai." Hopefully that's what happens. Dharmesh, come in here. We were speaking to the DIPAM secretary as well, and he mentioned that there's a flurry of deals coming in Q4, FY27, etc. But you have a great pulse of what institutional wealth will do. Jake's made a very important point. There is a bit of a turn in the FI appetite. Now that the deal is signed and one more event out of the way, do you reckon that FIs which have largely fled India in 2025 could make a meaningful comeback, or is it difficult to call?
No, I'm very positive that the FIs will come back to India. It's just how India treats them, how India wants them. Unfortunately, we've not treated them well with the taxation changes and the changes on the holding structure, that you need to diversify your stocks. You need to own 10, 20 stocks instead of 1 or 2 stocks. If somebody wants to own an HDFC bank, why can't he own it? So that's a technical issue which I think so the government has noted on it. I believe some action will happen very soon. But where do you go? I think so. For me, this is the best, India's golden decade, as I call it. That's what is happening to India today. Let's not worry about, 1 quarter, 2 quarters, stocks will underperform or they'll go overvalued, but the long-term story is intact. Manufacturing, for the first time, we are seeing this kind of boom happening from the last 2-3 years and many more. My friend Mr. Gujral is here from Sirma. They're seeing this kind of growth which nobody can even think of. So I believe India is in the cusp of a change, and anybody who's long-term, maybe 3 to 5 years, other than 1 year, should do very well. And FIs have nowhere else to go. So I'm very sure the money will come to India.
I was just thinking about the last point you made, Dharmesh, that we should treat FI as well. Hopefully absence makes the heart grow fonder.
Well, India, only things happen when there's crisis. So we
True,
and about this. Hopefully it should happen.
Correct. We've quickly moved from that narrative that SIP and the domestic investor is enough, and we now realize we need a more well-rounded market. Now,
if I may just jump in,
Sure.
I think we treat some FIs really well. There's somebody called Jane Street. Check out how much they've made vis-a-vis the rest of the world.
Well, sometimes you want to come in on that, Dharmesh. Please go for it. I think sometimes they get what they deserve.
Well, there are multiple number of FIs, so we don't want the JNCs of the world. We want the other guys. But even what's wrong in what JNC's done? They just taken a market opportunity.
When they love us.
Yeah, so
Okay, no, just to come to taking the conversation ahead, and I want to bring it down to the average investor that's watching also, because we are streaming this right now across the NDTV platforms, and we talk markets all day, but there's the average viewer over there whose SIP portfolio is looking bad, who is dabbling in individual stocks and is feeling dismayed and is wondering, yeah, gold hi le leta. So for them, Gurmeet, do you really echo what is being said here, that with everything that's happened in the last 8-10 days, the tide truly looks set to turn?
Yeah, so there are signs about it. So if you see, for example, the net inflows in emerging market funds have been over $20 billion. We lost out $4 billion. But last 3-4 days, there are net positive inflows. The AI trade is slightly softened. Commodities have slightly cooled. And if you see, the Dow Jones have outperformed NASDAQ. The S&P transportation index is doing better than the tech stocks. So once, and you know, a lot of it, while we keep saying tech, but there is a very big angle of brick, and as Neeraj says, pick and shovel story around AI. You know, you need power grids, you need data centers, you need metals, and I think once that story starts coming out, something like India, which is a more traditional market, will start finding some allocation. That's my take. I think the disconnect, Tamanna, has been the real economy is not reflecting in corporate earnings. So what you see as a Goldilocks, which is high growth, low inflation, somehow the corporate earnings are not reflecting that.
Some would argue Q3 was much better than expected, especially in small and mid-size.
Yeah, but I'm saying, so for example, look at banks. Credit growth is back. Now, SBI at 47 lakh crore asset balance sheet is now guiding for 13 to 15% growth. Now, that's a big number. You know, it's the highest ever PAT I have seen for any Indian bank in a quarter. So, SBI will do 85,000 crore PAT. That's like $10 billion, right? So, BFSI is showing that. And you see there is record FDI in BFSI. We've got $10 billion between RBL, Federal Bank, Shriram, right? And there's more lined up with IDBI, with, you know, more banks. So I think wherever the earnings are coming back, I think the FIs are coming. And then long-term money is coming. You'll see that in data center. I think wherever the earnings are weak is where we are seeing. So I think it's a bit of a churn. Maybe it should mean revert. Seeing early signs, but fingers crossed.
Pretty interesting. By the way, we got the inputs from the DIPAM secretary that we'll hear some definitives around IDBI by end of March. So that should be interesting. Devina, let's nail it down then, right? You look at quadrants, you look at markets within quadrants, and you look at sectors within quadrants as well, right? Where is it that if Devina Mehra is slightly more optimistic than she was in 2025, that she finds favor? What themes, real commodities, tech, what is it that you like? Within India, by the way, yeah.
Yeah. First of all, I don't believe in narratives and stories. I don't believe in high conviction, because high conviction is nothing but getting married to a story. So we always look at data, and we look at data afresh every quarter because data changes. And just to go back to some of the conversation that went on in terms of Q3 earnings, the interesting thing was, if you look at my interviews last few months, I had been saying that I expect an uptick in earnings in Q3, which didn't quite come through. And part of the reason which has been missed out, which I had posted on, was the new labor code. That had a significant impact on earnings, obviously in BFSI and IT, but pretty much across the board. So much so, I think I looked at it when about 50% of the Nifty 100 earnings had come out, and the PBT on the reported PBT had not even gone up 1%. But if you add back the NLC related provisions, it was about 8.5–9% increase. So, you know, some of it got hidden in this whole the labor code implementation, especially for companies. But it was not just BFSI and IT, even, you know, Indigo and L&T and all that had significant number provisions there. In terms of, again, I mean, we are in the process of a rebalance, so this may not hold 6 months later. But last 2 years, we have been overweight auto components and slowly auto also, which did well last 2 years. Pharma and healthcare, we've been overweight, which Jake's mentioned, did well in 2024. 2025, you can say, was a consolidation phase, but we still remain positive there. 25, we've added banks. Normally, we are a nervous investor in banks, so we're still not overweight banks, but we hold more than we normally do. So first half of 25 was PSU banks. Later on, it was some of the non-PSUs also. What else? So more FMCG, we slowly became overweight. I mean, more companies came on our systems. Others are bottom-up picks. They're capital goods, there's chemicals. IT would be probably market weight. So that would be broadly where we are. But also, I mean, FIIs are being discussed so much. I think I must have told you this also sometime or the other, that we all ask, will the FIIs come back? And inherent in that is an assumption that when FIIs come in, the market goes up, and FIIs go out, the market goes down. But I go back to my school days, and my maths teacher would always say that from this step to next step, is it really implied, or are you making a leap of faith or leap of logic?
But 2025 showed that, right?
No, but if you plot from over a longer term, every month the FII flows and the market movement, you'll find there is no correlation, let alone causality, there's no correlation. And I speak as one who started this business because the FIIs came in.
Yeah.
So I've been there right from the beginning. And even at a broader level, in 94 is when the FII money started coming in. There was no Indian mutual fund to speak of. There was no great retail investment. So you would have said that this great slew of money which didn't exist is coming. It would really drive up the market. 94 to 2003, only 9-year period in the Sensex history with net zero returns.
Wow.
So that is
Are you
the data.
making the
Rest
point-
are stories.
Are you making the point that we don't really need FPIs in Indian
I'm
markets?
saying I track FII and FDI from a balance of payment perspective, but not from a market direction perspective. I think we need lots more FDI. We've been doing pretty poorly on FDI, and the net FDI has been pretty poor.
So in that case, how do you determine, and I'll open up this question, the largest pain point for Indian markets? There was a time when people used to say Indian markets are disassociated with what's happening in the economy. Economy was weak, Indian markets were still up. Maybe the reverse is happening now. Your macro indicators are fine, your high frequency indicators are fine, you have FDI coming in, you are the fastest growing economy in the world, you're cracking trade deals left, right and center, but markets have not responded.
I mean, are you asking me? Okay, so, markets will frustrate you. They will not do what you want them to do. The biggest outlier example I give is China. China's market made a high in 2007. Its GDP went up 7 times and that high was not taken out till about 8, or because in terms of returns also, we are not above the trend line. So, which is why I'm saying that this is a time to remain invested, because if you look at the long-term trajectory of returns from Indian markets, the 1980s decade was a 21% compounding. 100 rupees became 700 rupees in a decade. Next decade was 14%, then 17%, and then 8.5%. The 10 to 20, you got, if you 100 rupees became only 230 rupees, which you would have got in fixed deposits. So that's why you had room for a run, and we are still not above the overall long-term trend line, which is why I'm saying I don't see the risk of a big crash, which is the point that you remain invested. You don't know when the up move comes, because in 40 years, if you miss out 10 best days, you give up 2/3 of your returns. If you miss out 30 best days, you give up 90% of your return. So unless you see a big crash coming, most of the time it makes sense to remain invested. And the big moves come. One move, of course, came recently also, but most of the time the big moves come when there is fear, despondency, anxiety. They don't come in a mad bull run. The only time those sharp moves came in a mad bull run was the Harshad Mehta Teji, which was a rigged market. Otherwise, it's never happened that you have one-day moves which are of that kind of size.
Wow. Okay. Okay. So then, sorry, any of you want to add to this? Because Tamanna just opened it. Yeah, sure, Jay.
Since we talk
And then I'll
small
ask my
investors, and I think it's important to, 2 points here. One is this thing about SIPs and whether they should do it. There was almost a consensus a year and a half ago that the only number being tracked was the SIP number. And it's almost as if the individual investor felt he was ordained to make money simply because he was doing SIPs. And therefore, this thing about a 30% return or 20% return, where people felt that at the end of a year, I'm going to see X plus 15, 20%, and they realized that had they put in a fixed deposit, they would have outscored the market, 6:1 on return. So one is, the only way SIPs make money is you're hoping that over a period of time, the fund managers whom you have invested through will start beating indices, etc. But the index itself didn't yield much. And as most fund managers have actually demonstrated last year, they haven't been able to really beat the index in that sense. The second point, which is, I think, equally important on this FI thing is, the contra to the FI has been the FDI flows. And if you see the FDI flow, Gurmeet referred to it, whether you talk about the smallest of the Samman Capital, then you talk about the Federal Bank Blackstone deal, or RBL Emirates Bank, Shriram, etc. The total committed capital, including, I think IDBI may be largely secondary, so I'm not counting that in, is close to $10 billion of primary equity has gone into a system which largely leverages itself 8 to 9:1. In India, there's this phenomena that NBFCs are equity rich but debt poor, and banks have been equity poor but debt rich. And that system has got $10 billion of fresh money, which means $80 billion to $90 billion of fresh lending can happen, which means the credit cycle is about to take off right now. And if you believe that all money is coming into this, you may well have a situation that the FDI is the highest in this sector, but the returns from this sector over the next 2-3 years, because the money has been front-loaded, may actually have peaked out. So you have to constantly look at non-over-owned spaces, spaces that are not, in favor, and take that leap of faith. I mean, if money making was that easy, then you democratize money making and poverty would disappear. Right?
Exactly, that doesn't happen. Very valid point. Okay, in which case, Dharmesh, I'm going to come to you on that question. What about themes which haven't made money in the last 12 months, right? You think of, sorry, we have two representatives here, so I'm going to mention that. Sarma may have done well, but EMS hasn't, right? KP may have done well. Energy transition in the last 6 months, 12 months hasn't. And there are multiple other themes. What about some of those beaten down sectors? Is there merit there?
See, also you have to understand why they have not done well. There is obviously a tariff hangover, especially on EMS, right? So a lot of those stocks are suffering. It's just few days back this has happened and you see all the EMS stocks have actually outperformed. So I would not like to go with, few sectors specifically, but I would say you have to understand the fundamental reason what's happening around here. And, just to talk on what Jakes was saying, as I said, we are trying to do too micro on the returns. It doesn't happen overnight. The size has changed, As Devina mentioned earlier, FIs, but those time FIs had an impact on the market. Today they don't have, because the size of Indian domestic investor has changed.
They didn't have an impact even then. That's the whole point.
But they were far sizable than any domestic investor were.
Even so, there was no correlation.
Yeah, but I don't look at markets only as index. It's more broader 500,000 stocks which matter. Because we just get misguided by the index. 30% is banks. If the banks do well, markets show you a different picture, right? So it's more more broader level is what we need to see. The kind of changes which has happened in India has just happened now. The trade deal has just been signed. We still don't know the details also coming out. What's going to be the impact? I think so. One has to be more patient. When the markets are hot, everybody was saying that valuations are crazy. Now suddenly valuations on the other side, everybody should scared. So I would say this is a good time to be an investor in these markets. As Jake said, buy the things which are under-owned, or things can make substantial changes. I think so. That's coming through. I would be very bullish on India, to be honest, today. And I would not like to be on this panel to say what to buy, but definitely this is the time to buy.
Paji, aap bata do. Thoda josh lao.
So I think from under-owned sectors, I think chemical is one space one should look at. I think there's a lot of capex which has happened. Without taking stock recommendations, like look at what Deepak has done or Aarti has done, and returns have been very poor. Something similar happened with the CDMO. Market was ignoring what a Divi's or a Laurus and etc. were doing from 22 to 24, 25. It was a very focused capex, right? So that's one space one should watch out for. Valuations I think they're COVID kind of valuations, if I can use the word. I think textiles is another space. So I'm seeing there are a lot of non-glamorous sectors which haven't done well. And so, for example, textile employs 4.5 crore people. That's second largest after agriculture. Right? So there's a lot of pain in the informal sector if you go to Tripur and go to some of the wholesale markets, right? So that can come back. Also some of the, bottom-up names, for example, the infrastructure, economy-facing sectors. You see Hitachi Energy con call yesterday. They spoke about huge backlog in power grid and huge opportunity they are seeing in, T&D, data centers, mobility, etc. I was listening to some of the earlier con calls, L&T. So I think a lot of the economy-facing sectors, can do well. I also think selectively IT could do well. I think there is just too much, and especially the IP-driven names.
I'm actually going to ask you on that, and I wanted to ask everyone. I think IT stocks view is divided. Is it the end or next chapter ka beginning? Let me put it that way.
See, I think it will be selectively. I think there are a lot of obituaries written. We had a Y2K moment.
The more you say selective, the more I'm going to ask you which ones you're selecting.
So I think, as I said, so look, example, not a recommendation. Look at HCL Tech, for example, in large cap. The software business takes 10% of the revenue but does 22% of the EBIT. It's a 25% EBIT margin business. Their dependency on IT services is very low. You look at something like a KPIT. It's actually an IP business. See some of the IPs they have. Look at what Persistent and some of the other names are doing. Coforge did a massive inorganic acquisition, some time back. So I think we should not paint the entire sector. And also they are cash rich, right? So once you are cash rich and if you can able to...
That's why they're getting punished. You're sitting with cash while everyone was developing AI. What were you doing? Dharmesh, I want your view on this. If you will comment on the broader view, I'm not asking you for any recommendations.
I only learned in the last 30 years, whenever people call the end, it's never the end. And whenever people say this is the best thing to happen, things go wrong. So, yes, AI is the new in thing. I believe this companies also will evolve. We are a services-driven kind of a country. So, yes, definitely we require investment into the product side, which I believe will happen overall, but this cash flows will go to that. It's a matter, yes, we are left behind the race, for sure. But doesn't mean that we'll never be able to do it. So I wouldn't say that the whole sector is over. In fact, that's the time to buy, whenever people say that.
You would put new money in service-facing IT companies today?
At a valuation, why not? It's always in the price. So what's at what price I'm getting it, I put in it.
Okay. On that note, we have to wrap it up. We can go on and on. We wanted to talk to you guys about primary markets. There's so much happening there. Dharmesh, definitely one word from you. This 2026 is going to be as exciting as 2025 for you?
Well, there's infinite supply of paper coming. So
Infinite.
So, and obviously you require that paper if you want to grow, or else India can't grow what you're talking about. For
Sorry,
that
you
you
were
require
saying?
money.
I think there are 300 DRHPs approved. So actually it was not FI selling. It was actually promoter and domestic supply, which together with FI actually. So there are 300 DRHPs already approved by SEBI. Moment the sentiment changes.
The number is 250 and almost 135 got the SEBI approval.
Tamanna, we should keep going for a bit. On
Yeah,
this,
no,
if we
but
can.
I have to ask Dharmesh about this. There's so much controversy on this. Suddenly one Sabziwala is also bringing an IPO. One garage guy is also bringing an IPO. I mean, you're sitting at the gate in that sense of this entire pipeline. How many of them are actually good, Dharmesh? Ab sach bata do.
Everything is good at a price, I always say. So it all depends on what price you bring those IPOs. And it's not that everybody's going to get money. A lot of people go back to the drawing board. They may not happen. But if it is a good price, there is no problem of, people investing in those IPOs. And you've seen that. I'll give you a great example. In the last few months, all the large tech companies or e-commerce type of companies have got raised money. Everybody knows there's almost going to be 70-80% of supply coming back in 6 months. And look at the performance post-listing, they're doing phenomenally well. When you know within 5 months of listing, you're going to get another huge wall of paper coming in those stocks. But people are buying. Why? Because they believe the story. So wherever people believe the story and see there's a growth, they are going to buy at a price. People think IPOs are crazily valued. I'm of the other camp where IPOs actually, very difficult to value IPOs today. In fact, they are the most undervalued as of today when you ask me.
Wow, that's tall.
Any responses to that
any
down
response?
here?
Devina laughed out loud, Devina.
Of course. I mean, look at some of the IPOs that have come now, or for that matter. See, IPO frenzies come and go, and they have been there as long as stock exchanges have been there. I mean, there's 400 IPOs on the Paris Stock Exchange, I think in 1881, where at the roadside food fella was giving you prospectuses. In India also, we've seen many times, 2021 being a good example, as when all these so-called new age IPOs came. And at that time itself, people were saying, value it on 15 years out earnings. The fact is that for most of them, the peak financials were just before the IPO, which is true of far too many IPOs. And the other concern, if you look at 2025, is the quantum of offer for sale in the entire IPO. So it is the retail investor who's giving an exit, not just to the promoter, to the first round investor, second round investors. And most of the time, the IPO valuation is 2, 3, 4 times, sometimes 8 times the last fundraise. So these are not, undervalued as a group. I mean, they would be the odd one. And there is no other way to value an IPO compared to a listed stock. There's only one way to value a stock. And too many people get in thinking this is a lottery game, and which shows in the SEBI statistics also that not the funds, but of the individuals who get an allotment, if it lists at a premium, most of them flip out within 2 weeks. That's the data. So they are not even making an attempt to value or buy a company. They think they are participating in a lottery, and that's never a good thing. So that's never a good thing. I mean, you have to be cautious. And offer for sale, in theory, is not bad if the company doesn't require any more money. But if you are doing a 60% offer for sale and are back in the market within 8 months saying I need more money, as was the case with Swiggy, story. That's a problem. I mean, you can call me old fashioned. I started my life as a credit analyst. I do look at risks first. If you start as an equity analyst, everything is hunky dory and every company has a great story. I have never met an entrepreneur who's not a great salesperson.
Well, we've got on the podium two people who have listed entities, by the way, so they're entrepreneurs in their own right, if you will.
You know, actually, there's nothing wrong with IPOs. The market gives the verdict. I think the reality is people use the IPO in a sense to defease their FOMO, which is to say, and a lot of funds have participated. If you go through the anchor book in most cases, you wonder why somebody's putting in 20, 30, 40 crores. And the reality is that they flip out to get that little alpha because the broad market is not giving you the returns. That's unfortunately what's happened to my mind. A lot of sort of on the edge funds are flipping out. And I
so
think
Jake, sorry. I want to come in there. So you are there is a lot of chatter, right? That happens ke mutual fund ne is IPO mein paisa kyun dala? You are saying that is not necessarily a problem.
I don't think any of this is a market forces. People are trying to figure out ways to eke out returns in a period of 12-15 months when indices have done nothing. Let's be clear, fund managers also are constrained. If they feel the grey market premium is strong, put in money and flip out, there's nothing wrong. They're trying to generate returns. As far as IPO pricing is concerned, I mean, of course, we will agree to disagree about the undervaluation. And between you and me, I have the greatest respect for Dharmesh, who is actually the IPO king today. And I say this, I genuinely say this. I mean this in the bottom of my heart. Having said that, if something sells, and why not? I mean, you're there for this. But the market is giving you the verdict. The kind of big IPOs that are collapsing post is an issue that I think the markets will learn to, and there's nothing good or bad about this. I mean, that's...
So, in fact, there are a couple of very good IPOs coming. So, you have Geo Platform, which in my view can have a significant impact on the entire, ecosystem of digital. I think there is NSE. I mean, NSE at today valuation is 40 times. So I don't see assuming the price band is what it is. And then
currently, as an unlisted share, it's trading more actively than a listed share.
Okay, we have to wind up, but
Actually, I can just make one statement.
Okay, to be fair, everyone had the opposite point of view, so IPO King must get one chance.
I would strongly say this, that IPO in India is the most inefficient process. So you have to understand how an IPO works. There is so much inefficiency. There is so much, price risk involved. So many days go in launching an IPO, almost 9 months. Things change. And that's why I said, become a banker, you'll come to know how easy it is to price an IPO. Not that easy. Trust me.
Okay, we have to wrap it up here, but this has been a fascinating conversation with a superb lineup of speakers. Thank you so much for coming in and joining us on the NDTV Profit Ignite Conclave today. Thank you.
Keep it going, ladies and gentlemen. Please allow me to take a picture if you don't mind. I'll send it to you, don't worry.